I am not feeling too well today, but since it's a 1 hour session, I don't think that should be a hitch. I will try my best to complete the entire presentation. My voice will be a little coarse. Please bear with me for that. There are a lot of slides in here. Obviously, I will be sharing the presentation, but I'll be taking the important aspects here which are relevant for today's topic. So, what are we going to cover today? We are going to cover today the tax concerns which arise on issue of securities. Okay, now securities will cover the equity shares, CCPS, OCPS, OCD, CCD, RPS. So all kinds of instruments that are there. So we'll be covering that today. So with that, I think let's move forward. This is going to be my presentation outline. We are going to start with 56 to 70. Then we'll go to 68. Then we'll see how does transfer pricing interplay with 56 to 7B. Then whether 56 to 10 can at all arise in the case of issue of securities. We will see that. And if yes, then can DTA come to your rescue? Okay. So let us dive right into it. This is kind of an overview which provisions can apply in case of which securities. 56 to 7B is applicable only in case of shares. So if it will apply to issue of equity shares, compulsorily convertible preference shares, as well as optionally convertible preference shares or redeemable preference shares. Okay, but it does not apply to issue of debentures. So therefore, if a startup is issuing debentures to CCD, startup, that's general connotation, any company that is issuing CCD, OCDs, 56 to 7B is not to be examined in that case. Okay. And simultaneously, you also need to see section 68, section 68, second proviso. Okay, so erstwhile this was first proviso. Now, because of insertion of first proviso, the share application money proviso is shifted to second proviso. Now, that proviso specifically talks about share application money and share capital. So there again, we are talking about equity share, CCPS, OCPS, RPS, but we are not talking about CCD, OCD. Now, whether CCDs or OCD will get covered under the first proviso, that is something that I will take when I go to section 68. Now, whether at all transfer pricing has a role to play. So I think everyone is aware because of the Vodafone Bombay High Court judgment that typically, there is no income that could arise on issue of securities. But now, because of 56 to 7B, can I now say that yes, income can actually arise on issue of securities? Because now, so erstwhile what used to happen is that non-residents were out of 56 to 7B. Now non-residents are also within the purview of section 50 to 7B, meaning when the company issues securities to non-residents. So therefore, transfer pricing can at all apply. And the last pertinent question about section 56 to 10. So that's kind of a perennial question, does it apply to issue of equity shares, CCP, CCPS, OCPS, CCDs, OCD? So that could be by way of primary issue, uh, private allotment. That could also be by way of rights issue, bonus issue. What about conversion? So when CCPS gets converted into equity shares, or if CCDs get converted into equity shares, OCDs get converted into equity shares, at that point in time, do you need to check 56 to 7B and 56 to 10? Okay. So that is also a very interesting issue, and that is also something that I will cover. Okay. With this, let's move on to 56 to 7B. Okay. This slide is just overview. Why was 56 to 7B at all introduced? So that was because it's an anti-abuse provision. Everyone knows that. It is basically to curb the circulation of black money by way of issue of shares at premium. Okay. So that was the intent. Rule 11 UA is the rule, concerned rule, which talks about how to value the security in order to determine the fair market value. Okay. So certain tenets of the section are, if you are issuing shares at a value which is more than the fair market value, then you have to look at 56 to 7B. Okay. Certain exemptions are given. So these are certain exemptions given when a company issues shares to a venture capital company or a venture capital fund or a Cat 1 or Cat 2 AI. Okay. or if it's the company is a startup which is recognized and registered with DPIIT and also has taken, income tax registration for uh, 56 to 7B. So 80 that's a separate section, but your 56 to 7B, there also specific form needs to be filed in order to apply for this exemption. Okay. Now, what has changed as per Finance Act 2023? So till this point in time, it was only the residents who used to subscribe to the shares, and that situation used to be covered under this section. Now what has happened because of the new provisions, just one moment. Okay, so 56 to 7B, if we read that out, where a company not being a company in which public are substantially interested receives in any previous year from any person. Okay, so the words being a resident have been omitted. So now if the consideration is being received from a non-resident also, in that case also this section gets attracted. Okay, so what does the section talk about? So consideration for issue of shares that exceeds the face value, then the aggregate consideration which is received for such shares which exceeds the fair market value of shares. Okay. So obviously, first condition is that it has to exceed the face value. Okay. Second condition, again, it has to exceed the fair market value also. Only and only in that case can 56 to 7B at all apply. Okay, so therefore here I have just spelled out the different situation. If it is at face value, then no 56 to 7B. If it is in between face value and fair value, so say face value is 10 and fair value is 100. So if I'm issuing it 80, again no angel tax. If it is above the fair market value, see if I'm issuing at 150, then it is on 50. Obviously, if at all the total consideration exceeds 50K INR, which is a very small threshold that has been given, at least for issue of securities. Okay. Oh, this is the actual section. I think I've already read that out. So from any person, it can be resident or non-resident, which exceeds the fair value, any consideration that exceeds the, okay. So here the words are face value and here it is fair value. Okay, which exceeds face value as well as the fair value. And this we have already seen certain exemptions are given. Why are these exemptions given? Because there can't be any situation, or at least that's a presumption, that a situation of unaccounted money being flowing through a VCC or VCF usually does not arise, as well as specified fund has been defined, that is CAT 1 AIF and CAT 2 AIF, because of the stringent KYC norms, etc., so on and so forth. Therefore, unlikely that any unaccounted money can flow through by way of excess share premium into an Indian company through VCC, VCF, or AIF. So therefore, that is been excluded. Now, under this, there are two notifications. One is where it refers you back to the DPIIT notification and states that if you are a DPIIT recognized startup, okay, and if you are issuing shares, then you are exempt. 56 to 7B will not apply. Second is where they have notified certain entities. Okay, entities, and I think I should use the word person, because there are different types of entities that have been notified here. So this is the first notification, this is the second notification. So we refer to both the notifications. What does the startup recognition DPIT notification talk about, and what does, and which kind of persons are notified under 56 to 70 proviso 2. Okay, this is kind of a consequence. So if at all you fall under the notification, okay, here, but then you are not able to meet the conditions. Okay, so say suppose uh, you have the startup recognition, but then there are certain conditions given in the DPIT startup notification, and your turnover including no, not your turnover, your share capital including the premium, including the proposed premium, cannot exceed 25 CR. Now, suppose, in seed one round or seed two or maybe series A. Series A usually goes far beyond 25 here, but let's assume, seed two. Okay. So there your share capital including premium is at 20 CR. Now between C2 and Series A, if you have a bridge round, in bridge round, if there, so typically bridge round, it will not be equity share, or it will be convertible instruments. But let's assume for a while that it is equity CCPS that is being issued. Okay. In that case, if the share capital, including the premium, exceeds 25 share, you lose the startup exemption. The moment you lose the startup exemption, whatever excess is there, that will be taxed in the previous year in which the failure to satisfy the notification comes up. Okay. And then what happens? Obviously, it will be counted as misreporting, so therefore it will be two times penalty and not under reporting. Okay. So therefore, this is the kind of penal consequences that are there. Which are the notified classes of persons? Okay. So again, just like there is a presumption that unaccounted money cannot flow in through VCF, VCC, or AIFs also. Similarly, when these persons actually invest into Indian companies, which are typically private companies, in that case, uh, the section should not apply. Okay, so it is government directly investing or government related investor. It may be central bank, sovereign wealth funds, it may be multilateral organizations, or where government has ownership of more than 75%. Okay, then it would be banks as well as insurance business. Okay, so this is kind of a long term money. So therefore, unaccounted money flowing in through share premium situation shouldn't arise. Apart from that, there are certain additional entities also, but only and only if they are a resident of specified countries. Okay, so we'll see the which are the countries that have been specified. But again, this is kind of a broad-based pool of investors. So here again, it is FPI category 1 license, endowment funds, example Howard Endowment Fund, pension fund, Canadian pension fund, and this has been kept open, broad-based pool investment vehicle. But how do you define that? Where the investors are not less than 50. Okay. So therefore, broad basing is there. And that fund is not a hedge fund or which employs diverse or complex trading strategies. Okay. So therefore, funds which typically are long funds. So those are the funds that would typically come under this. Now, which are the countries that are covered here? Okay, so Australia, Austria, Belgium, Canada, Czech Republic. Which funds come through Czech Republic? Denmark, Finland, France, Germany, Iceland, Israel. Yeah, some funds I think I have at least seen FPIs coming through Israel, from Israel, not through. In US, UK, Sweden. So here what you will see is Netherlands not covered. Okay. Singapore not covered. Mauritius not covered. So how have these countries being selected? There is no thought process behind it, but obviously thought process would have been there, but it's not in the public. So therefore, we'll not come to know what is the thought process for excluding at least jurisdictions like Singapore. Okay, so they have stringent KYC norms also. So not really sure why they are not included. Uh, so yeah, these were the notified persons. What about startup DPIT notification? Okay. So the conditions here are, yes, in order to be eligible for this, you need to be first recognized by DPIT. Second, I was talking about the paid up share capital plus the share premium after the issue should be less than 25 share. The moment it exceeds, it means that you lose the startup exemption after all. Apart from that, look at the kind of stringent conditions that are there. For a period of 7 years after you receive the money, you cannot invest into. So these are very natural, obviously, because these are all dealing with fund diversion. Okay, you cannot invest in any residential block unless you run your business from there. You cannot invest in any other land building unless it is held for your business. Loans and advances cannot be given, so on lending is not permitted. Again, further capital contribution to any other entity is not permitted. Okay. You cannot buy any light asset also which is greater than 10 lakh INR rupees. And obviously, you cannot buy jewelry out of it. You cannot buy art. You cannot buy bullion. You cannot buy a yacht. Yacht is already covered here. So all these assets, basically, the intention here is that fund diversion should not take place, and only then you will get the benefit of the uh, notification. Okay. Just 1 minute. How do I minimize this screen share option? Uh, just 1 second. Hide floating control. Okay. Okay. So, in effect, what is the consequence of angel tax provisions? Okay. One we have already seen the simplest that it carries an additional burden in order to do the valuation under Rule 11 UA. Now, new rules have also come in for valuation, which we'll be covering immediately next after this. What about this? Yeah. What about this? What about at the time of conversion? Okay. Do I again need to consider 56 to 7B? At the time of issuance, yes. Okay. So issuance, since it only talks about shares, it will cover equity shares as well as CCPS. But what about conversion of CCPS into equity? Again, do I have to do 56 to 7B? And for CCD into equity, do I have to do this 56 to 7B valuation for the first time at the time of conversion? Okay. So I have found at least two case laws, one for CCPS conversion, one for CCD conversion. Both are against, unfortunately. So for CCPS conversion, there is a case law of ITT Chennai SA Metro Plot. For CCD conversion, there is a case law of Milk Mantra. What does the CCD case law talk about? So, in very interesting perspectives under both. For CCD, what they're talking about is you are getting some consideration. Okay, although it is non-cash consideration, it does not talk about consideration only in monetary terms. If you see 56 to 70, so it talks about any consideration for the issue of share which exceeds the face value. So here in the case law, when you see the reasoning that led the ITT to give the judgment uh, not in favor of the taxpayer. What it said that you are coming out of the terms of CCD, the restrictive terms. Okay, your debt ratio will improve, and along with that, a lot of covenants will go away. So therefore, there is a consideration that the company is receiving upon conversion of CCD into equity shares, though it is not in monetary terms. It is improving your financial strength, and so and so forth. A lot of considerations have been given. So therefore, upon debt getting converted into equity, so the burden is lighter on the company because it is getting discharged from a lot of restrictive covenants. And therefore, it said that yes, this is the precise non-monetary consideration that the company is receiving, and therefore 56 to 7 we should apply. In my view, reasoning is a bit on loose footing, but obviously that's my personal view. When we go to CCPS, obviously, uh, whenever a conversion event happens, okay, CCPS or CCD, it is only constructive consideration that is received because original consideration would already have been received by the company at the time of issue of CCPS or CCD. So therefore, really, consideration which is received by the company should ideally be only at the time of issue and not upon conversion. So upon conversion, it's not receiving anything new. It's only constructive consideration that it is receiving. But this line of argument was not accepted by the ITT. And here is where we stand. So what is the consequence under different laws? Okay, under company law, you need to do valuation at the time of issue of securities. By a registered value, here again it has to be more than the fair value. Under FEMA, who can do the valuation? CA, CMA, merchant banker. Here again it has to be more than the fair value. Under income tax, it could either be by a merchant banker or even self-determination. So even if you see rule 11UA2. Under that, for the first method which is there, anyway, it can be self-determined. There is no requirement for a valuer there. So here, if the issue price is greater than a fair value, then a difference will be brought to tax. Obviously, if the total consideration difference exceeds 50,900. So here is where for an issue, you need to have different sets of valuation under different sets of law. Okay. Then we dig into Rule 11 UA. Okay. When it comes to residents, okay, so consideration that is received from resident, which are the methods that you can use? NAV can be used, DCF can be used here, but only a merchant banker can do the valuation. So the position continues. This was there earlier also. Well, there's a new concept of price matching that has been introduced. So what it talks about? It talks about a situation where a fundraise has already been done from a VCC or a VCF or a specified fund. Okay. In that case, a specified fund is the one, same meaning has been given under 56 to 7B2. Okay. So there you will again be uh, taking, will take you back again to AIF, CAT 1 and 2. Okay. And apart from this, now funds formed in IFSC, that amendment has also come in, and those have also been included. Okay. So if you raise capital from these types of entities, then the price at which you have raised, you can raise equivalent amount of capital from other entities also at the same price and up to the total amount of fundraise that you have done from these specific entities. Okay, there's an example which I have given, but I don't think it is very difficult to understand this. So say suppose I have raised 100 CR from a Cat 1 AIF, okay, at a price of 100 rupees. Then I can raise another amount of 100 CR. Okay. Say it may be 50-50, it may be 25-75, it may be between different persons, it may be in different rounds, whatever permutation combination, but it has to be not more than 100 rupees. And obviously, there is a time period given here. It is 90 days either before or after the share issuance, okay, to the AIF. Any of these. Again, the price matching concept has also been extended to the notified entity. Okay, the entities that we saw. So yeah, these kind of entities coming from these countries. Okay, so that is as far as residents are concerned. What is different when it comes to consideration received from non-residents? 5 additional methods. Okay, so two, 3, 4, and 5 additional methods have been given here. Here again, valuation needs to be done by merchant banker if it is under any of these 5 methods. Otherwise, this remains the same. NAV remains the same. Exactly. DCF again by merchant banker. Price matching concept is there for consideration received from non-residents also. Okay. NAV method. Let us go into that. NAV method, if you see, for 56 to 7B, NAV method is different, slightly different than for 56 to 10. Okay, so for 56 to 7B, here, when we consider the book value of assets, I don't need to consider the fair value of immovable property, then jewelry, art, bullion, and further investment in securities. Okay. Whereas for 56 to 7B, rule 11 UA2. So this is 11 UA2. Here, I can simply take the book value of these assets as standing on my balance sheet date. I don't need to do a fair value for this specific type of assets. Otherwise, it largely remains the same, not any difference beyond that. I don't think I will spend more time on explaining what NAV is there. It should be pretty clear. It's a very standard method. DCF is also something standard. I don't think that I should go into the detail. Which are these 5 valuation methods? Very, very interesting. Okay. So these are the valuation methods. Some of the methods that, at least for startup valuation, I have not seen. Okay. This is nothing but the scenario analysis, only big names used. So all these have been taken from IPEV, okay, Private Equity Valuation Manual, and also AICPA Handbook. Okay, you will get a description of these methods in that. Comparable company multiple method, any other comparable company that has done a fundraise, you can take that multiple at what X, it's a revenue X, or it is a customer base X, or whatever. Probability weighted is, yeah, it's there here. Okay, so here are a lot of multiples that are there. Okay, price to earning, price to book value, price to sales, whatever. Enterprise to EBITDA. In case of negative, bottom line companies, you take enterprise value to EBITDA. Then comes price weighted expected. This, as I told you, is a scenario analysis method. What you need to do is you need to project the exit value in case of alternate events. It may be an IPO, it may be an acquisition, it may be staying private, it may be liquidation also. Okay. So you plot different scenarios, project the value till that time. Then obviously you again do a DCF and bring it back to today, but after assigning weights depending on the scenario. What is the likelihood of IPO scenario? What is the likelihood of merger acquisition scenario? What is the likelihood of liquidation? You assign weights and then do a DCF and then find out the present value. Option pricing, Black-Scholes model. So here is where you assume that whatever convertible securities that you have, they carry a particular option to convert or not, as well as, okay, so beyond convertible securities, even if it is equity shares, then you have a lot of restrictive covenants, okay, ROFR, and put option, call option, whatever. You use the Black-Scholes model in order to derive a price there. There is a implied volatility that is there. Risk free rates have to be assumed. Okay, so this is based on the log normal distribution. Milestone analysis method. This is something which is kind of a uh, not a very scientific method, but here particular milestones are defined beforehand. Those milestones may be monetary, non-monetary. So it may be product development. At what stage? What are the revenue targets? Have you got certain regulatory approvals to start a business? So particular milestones are there. For each milestone, certain value is assigned. After you reach that milestone, since the risk decreases, the value of the company would increase. Okay, so that is how recalibration happens. Replacement cost, I am still wondering why this method is mentioned for 5627B. If it is a replacement cost, then it is unlikely that that would come in at a premium, right? So this is nothing but if you were to rebuild the company, then in that case, what could be the value? Okay. Price matching example. Okay, so here is where, okay, so 90 days I already talked about. So say 80,000 rupees, a very simple analysis. 50 shares issued at 160. Then another 50 shares can be issued at 160, so that total up to 80K consideration when within a period of 90 days from before or after the date of issue of shares to VCC. Okay. Same is given for notified entity, so I will not repeat that. So this is kind of a summary. Sorry, this is not summary. This is for compulsorily convertible from. So that was for equity shares. Now for CCPS. For CCPS, if you are valuing CCPS on its own, okay, not on the basis of a conversion formula or price. Conversion formula is nothing but ratio, okay, or you have a conversion pricing. If you're not valuing on that basis, if you're valuing on those basis, then you first value the equity shares, apply the conversion ratio or price, and then derive the value of the CCPS. So their equity shares needs to be valued on the methods that were already given before for resident, non-resident. If it is directly taking intrinsic value of the instrument, then obviously your NAV has no relevance. So therefore, in both cases, you will see NAV is not there, but otherwise everything remains the same. Okay, date of valuation report. Okay, so this is also important for private price matching concept, we have already got the 90 days period which is there. So therefore, apart from those situations, the NAV is as on a balance sheet date. So therefore, there I don't think the 90 days concept will come. So leaving apart the price matching concept, leaving apart the NAV, then if any method which involves valuation by merchant banker, so DCF plus 5 methods, then you can use the valuation report for another 90 days. So this is a very, very important relaxation that has come. Another relaxation that has come is for safe harbor. Okay. In case of NAV or DCF method. So why safe harbor is not there for price matching? Because price matching you have to match the price exactly up to the price that has been adopted or considered for issue of securities to notified entities or any other funds. So therefore, their safe harbor shouldn't apply. So therefore, when should it apply? It should apply to other methods. So your NAV and DCF, because 5 methods are not there for residents, your 5 methods as well as NAV or DCF. So this was as far as the 56 to 7B is concerned. These are certain general principles that are arising out of judicial precedents. How to apply Rule 11 UN? I think now it is well settled by now. Bombay High Court Vodafone M-Pesa decision which is there, which says that the AO cannot change the method. Okay, suo moto. So no right to change the method. What can the AO do? The AO can scrutinize the valuation report. Obviously, he can call for everything. Where have I written that? AO has to record the reasons for not accepting the valuation report. When can he not accept the valuation report? When the assessee is not able to satisfy what correctness of the projections, discounting factor, terminal value. A lot of times what happens is ad hoc percentages are adopted, but you need to have a scientific basis. I know valuation is not a perfect science, but say even though you still need to justify why you have adopted a particular figure or a percentage or a factor. If you're not able to do that, if it is not scientifically derived, then obviously you give the AO. So therefore, the primary onus is on the SSE. If he's not able to discharge the burden, then obviously AO has the right in which he can go for his own valuation, okay, or even opt for. So own valuation meaning he will vary any of the data. It could be discount effect, or terminal value, projections, okay, or else he can go for altogether new method also. That is fine. Now this principle is also very important. Okay, so this basically talks about that you cannot do a scrutiny of the data by referring to the data in the at the date of the assessment. Okay, so this is nothing but a X post analysis. So therefore, as on date of the assessment, the AO has no right to actually check or validate whether the projections have actually turned out to be true in the present terms or not. Because only at the time of doing the valuation, what is the thought process that would have gone, that is something that needs to be validated, but not with the exact current data. Next, we go to section 68. I know I'm running out of time. I'm a little quick, but at least I will cover the important slides in this presentation, so no need to worry about that. Cash credit. So again, this is again anti-abuse provision like 56 to 7B, but this is a far more serious anti-abuse provision because here it is directly unaccounted money that is found as a credit in the books of accounts. Okay. 56 to 70, there is an instrument that has been issued. There is a corporate law procedure that is followed in order to issue the shares, do filings, etc. So and so forth. Okay. Plain reading of 68 says that yes, any unaccounted money that the assessee is unable to explain in its books of accounts, then that will be taxed under 68. Here now, then there are two provisos. First proviso is for loans and borrowings, and second proviso is for the share capital. So we go to the second proviso, which is the subject matter of our presentation. Okay. So this is the general provision. I don't think I should go through it. Yeah, this is the proviso that was inserted in 2012. Provided further that where an SSC is a company, not being a company in which public are substantially interested, and the sum so credited consists of share application money. Okay, so share application money one, share capital two, share premium three, and any other similar amount. Any explanation offered by the SSC company shall be deemed to be not satisfactory unless either of the conditions. So, which are the conditions? Two conditions are there. First condition is when the person in whose name the credit is recorded is not able to explain the nature and source of the sum so credited. And second, that explanation uh, is not found to be satisfactory by the AO. These two conditions are there. A lot of overlap obviously between both, but important takeaways are yes, it is only for resident, it is not for non-residents. So when you're taking money from resident, only in that case, the second proviso for share capital, share premium, share application money that comes into play under section 68. For non-resident receipts, it does not come into play. What are the okay? So here again, just like we had certain exemptions under 56 to 7B, here also there are certain exemptions which are there. VCC and VCF, they are being exempted. Here, if you see here, specified fund is not there, so therefore here yeah, but if you again go back to 1023 FB, 1023 FB, I believe that also covers AIF, but I think it's only category 1 AIF, if I'm not wrong. Yeah, it is only category 1 AIF, it's not category 2 AIF, whereas in 56 to 10, it was 56 to 7B, it was category 1 as well as category 2, both AIFs were covered. So here it is only 1. Okay. Yeah. So, okay. This is the consequence. If it gets taxed under 68, then what is the rate? Obviously, it goes under IFOS. The rate is 60% plus surcharge plus education cess, and obviously it's on gross basis. There is no deduction which is allowed here. Okay, so I didn't go to the genesis of at least Finance Act 2012 proviso. Why did it come in? Okay, so there were a host of judgments right up to Supreme Court, which had created some hindrances for the income tax uh, revenue to challenge certain aspects under Section 68. Okay. So one was burden of proof, okay. Burden of proof, and second was source of source. Under burden of proof, many times it was held that yes, if you discharge the three tests, which are the three tests laid down? So this is coming out of obviously judicial precedents not there under the act, but now well settled. ICG test: identity, creditworthiness, genuineness. Okay, so identity meaning who's the person who's investing in you? Is he fake or is he real? Okay, so using fake pens, so that kind of example. Creditworthiness: is the person really having the net worth to invest in you? Okay, so net worth is coming out of what? Is it coming out of its own reserves? Is it coming out of borrowed fund? Somebody has lent money and you are only a conduit. So that comes under the creditworthiness test. And third one is the genuineness test. Genuineness test is whether the transaction itself is genuine. Okay, so gift received in cash. I'm just giving examples, it may be true or not. Gift received from persons who are not related to you. Okay, so at least relatives, there is an element of love and affection. So gift received from unknown persons, so that is covered under the genuineness test. Okay. So as far as these three tests are concerned, the primary owners, if the SEC discharges, okay, by diverging by submitting documents like PAN, certificate of incorporation, then creditworthiness, ITR, so on and so forth, then the judicial precedents erstwhile uh, under the erstwhile law, that is pre 2012, it stated that yes, then the onus shifts on the burden shifts on the revenue to allege that yes, identity is not correct, creditworthiness is not ascertained properly, there is no genuineness in the transaction. So, one of the amendments that was made is that yes, I still have to prove the nature. So therefore, your explanation about the nature and the source of the sum so credited. So therefore, Indian company receiving, and by the way, it is a presumption that if the money is coming from private limited, is being taken by private limited companies for issuance of shares, then it would be privy to the affairs of the shareholder. So that was a presumption under which 2012 amendment was made. So therefore, the Indian company would have prior knowledge of the identity of the creditworthiness and genuineness. So therefore, there is no question of primary owners and further owners. It has to be final discharge of the obligation that yes, you have to prove beyond any doubt the identity, creditworthiness, and genuineness. That is why that's the one of the reasons why the amendment has come in. And another was about source of source. Okay, so here is where to say this is an INCO. Okay, this is FCO. Okay, then there are shareholders. Okay, so this is investing money into INCO. Source is okay, FCO. Source of source is the shareholders or from wherever it's getting the money. So till now, the judicial precedents held that yes, if the Indian company is able to prove the source, from where am I getting the money? I'm getting the money from FCO. Whether FCO has sufficient net worth, yes, I submit the balance sheet, the financial, audited financial statement, so on and so forth. So my onus is discharged. Genuineness, obviously, through banking channel, then genuine. But now what has happened is, okay, FCO has a net worth. From where has it gotten the reserves? Okay, what is the business activity? Is it genuine? Is it not? Okay, has it come from loan funds? Okay. So all these things now the INCO also needs to keep a record of. Obviously, this is a very obligation which is very onerous, but that is something now that companies have to live with. Um, After the startup world has opened up to funding, I don't think that it is right to say that a private company would be privy to the affairs of the shareholders. Okay, and there is no reason to believe that shareholders would be willing to even provide all this data. Okay, we saw the exemptions only for Cat 1 AI. What about Cat 2 AI? Okay, what about startups which do crowdfunding? Okay, so many investors are there. How will you keep track of each and every investor? Okay. Okay. These are principles reiterating the section. I think I will skip that. Now coming to the last two aspects, 2 to 3 aspects, transfer pricing. Okay, so I already dealt with in the first slide. Bombay High Court decision, Vodafone, it said premium arising on the issue of shares is a capital account transaction, does not give rise to income, therefore not liable to transfer pricing adjustment. But this was pre FA 2023 when NR was not covered. Okay, non-resident entities were not covered. Now non-resident entities are covered. So therefore, there is an element of income that can come up under 56 to 7B. So therefore, can we now say that yes, at least there is an element of income that has come up. So can 56 to 7B indeed apply? So here is where what is my thought process. Okay, so situation one. Let's break it up into two situations. Situation two. Situation one, let's say face value. Face value is 10 rupees. Fair market value is say 100 rupees. Issue price. Okay. Issue price is let's say 150. And if you ask me about ELP, let's say it is 170. Let's go back to the basics. Obviously, why this had come up is because 92 is not a charging section. Very well laid down principle by the Bombay High Court judgment, also followed in the other judgments that are mentioned here. 92 is only a computation mechanism, and similarly that goes for rule 11 UA. But 11 UA comes out of 56 to 7B. Charging section 4. You have to classify the income under one of the heads. So therefore, IFOS 56 to 7B. 56 to 7B takes you to computation mechanism, that is rule 11 UA. So if I compare if I compare Rule 11 UA and if I compare ALP, I would find parity here. But I cannot compare 5627B with TP 92. I cannot compare this because one is purely a computation provision, second is not. Okay. So under this example, okay. So what can happen in this case? Since my issue price is greater than my FMV, so therefore 50 will get taxed under 5627B. Okay. FMV will be determined by Rule 11 UA. Now, once Rule 11 UA has already been applied by any of the methods, 5 methods, DCF, NAV, whatever, can the AO again refer the case to the TPO and say that, no, I have done my examination as per Rule 11, now you do yours under 92. And the AO, TPO will adopt a method which is not sitting with any of the methods, or maybe he'll adopt a method and not agree with the criteria there, then again, the principles arising from Rule 11 UA judgments will apply here. But assume that he's adopting a method which is not the method adopted by the SSE, and he arrives at a value of 170. Now, 170, so therefore TP adjustment could be 20. 20 will be charged to tax under which provision? Obviously, I have to. So 90, this decision specifically states that 92 is a computation mechanism. So therefore, I need to go back to the charging section. Okay. So 14, I need to classify it under any of the heads. I will go back to 56 to 70. Under 56 to 70, what does it say? Only and only if the issue price is in excess of FMV. But for the TPO, my issue price is less than the FMV. Because FMV as per the TPO is 170. In that case, 56 to 7B can never arise. Okay. So TPO may say that yes, it is chargeable to tax, but therefore you cannot charge something that has already been charged to tax under 56 to 7B and for which there is a valuation mechanism already prescribed. You cannot adopt a valuation mechanism which is not there under 56 to 7B, that so which is 92. Let's take the other example. FV is 10. Okay. FMV is 100. Issue price is, let's say, again 80. Okay. And your ALP is say 120. Okay. So first of all, since issue price is less than the FMV, 56 to 7B will not apply. Okay. If that does not apply, again, we go back to the same situation. If my issue price is less than the fair market value, at least for transfer pricing purpose, even though TPO may say, Acha, no, I will do an addition of 40, but under which section can you do that addition? 56 to 7B does not support that. So therefore, in my view, 56 to 7B is the primary section that would prevail over the TP provisions. You need to go through, adhere to Rule 11 UA principles. So that is my view. Let's go to the last section of this presentation, 56 to 10. Okay, we all know that here again anti-abuse provisions, here it's the other one, unaccounted money. Under 56 to 7B 68, it was flowing by way of premium. Here it is if the consideration is less. Okay, the other way around. These are all the situations that are there. Issue of equity shares, CCPS, CCD, RPS, OCD. What about bonus issue? What about rights? What about disproportionate rights? What about conversion, CCD into equity, CCPS into equity, convertible note into equity? Let's break that up. So let us directly go to this. 56 to 10 applies to all kinds of securities. So here it's not restricted to shares, which is there under 56 to 7B. So 56 to 10 applies to shares and securities. Securities will include debentures also. Now here, two sets of case laws are there. Sudhir Menon judgment, which is kind of the original judgment, in which rights was considered. But in that case, a lot of arguments were, uh, made. A lot of arguments were made. One of the contention was that yes, the asset has to be in existence, and there can be a transfer. If the asset is not in existence, where is the question of transfer? If there is no transfer, why should 56(2)(10) arise? Now, tribunal stated, no, the words used are not transfer, it is receipt. Okay? So, if I read 56(2)(10), okay, it says where a person receives. Okay? So, word user receives. It's not a transfer between two persons, receives. So, therefore, the tribunal said word user receives. In case of receipt of a share, yes, the shareholder is receiving the shares. It may be a new asset, maybe a pre-existing asset. We are not concerned with that. We are doing a plain reading of the section. So therefore, 56 to 10 will apply in case of issue of securities. That was a Mumbai ITAT judgment in case of Sudirman. Now recently, in August 2023, there is a Gujarat High Court judgment. Uh, it's there on Taxmann. I have noted that down. Yeah, so that is in the name of Jigar Jashwant Lal Shah. There, this contention was accepted. Okay, so referring to Supreme Court judgments in the case of Khudai Distillery, that if an asset is not in existence, how can you transfer that? So there, this contention was accepted, and then it was stated that yes, in case of issue of shares, 56 to 10 should not apply. So therefore, if it does not apply at that stage, then so it should not apply parallelly to shares, CCP, CCDS, RPS, OCD, all kinds of securities. So these are the two sets of judgments which are there. I would tend to agree, or I can't say agree because the Honorable High Court judgment, I would tend to follow that judgment rather than the ITT judgment. Why? Because if you see the genesis of 56 to 10, genesis is when obviously an asset is changing hands for unaccounted money. If the asset is not into existence, where is the question of asset changing hands and unaccounted money also changing hands consequentially? Okay. So placing reliance on the memorandum of 56 to at that point in time was 7, introduction of 7, then now 10. I think it can be fairly argued that yes, at least upon issue of securities, 56 to 10 should not arise. Okay. Assuming that, okay, so if we take that contention, then obviously for all the events that are there, okay, this is also new issue, this is new issue, this is new issue, this is conversion, new equity shares issue, new equity shares, new. Then for all the events, obviously 56 to 10 cannot arise. Assuming that yes, Sudhir Menon judgment, which again, relies on the plain words of the section. If that judgment is to be followed, then there are certain other sets of judgments which have come in favor of the SSE. One is the case of bonus. In the case of bonus, there is no benefit that is arising to the person who is subscribing at a value which is lower than the FMV. Okay. In case of bonus, it's very proportionate, right? If it is 1 is to 2 is to 1 is to 2 bonus, then the price directly halves. So therefore, there is no benefit being transferred between two shareholders. So in case of bonus, this section cannot apply. What about rights? So therefore, eventually in the Sudhir Menon judgment, it was mentioned that though for issue of new shares, 56 to 10 can arise, but relying on the judgment, relying on the memorandum, again, memorandum stated that yes, if some shareholders receiving benefit, okay, at the expense of another, okay, that's how unaccounted money is transferred. So some shareholders receiving benefit at expense of another by subscribing to shares at a lower price, because in the future they will be all selling at the same price, but here you are subscribing at a lower price, so therefore other shareholders are disadvantaged and you are getting an advantage at the expense of them. If it is proportionate rights allotment, then in that case, 56 to 10 should not apply. What about disproportionate rights allotment? So here also you'll get set of ITT judgments stating that yes, it is not in my hands to control the action of other shareholders, whether they want to subscribe to their rights entitlement or not. My intention is that yes, to whatever entitlement that I have got, I have subscribed to the fullest extent. So therefore, in that case, it is an event which is beyond my control. So therefore, you cannot tax me for that. So you will find favorable judgment year. Here, there is uh, for 56 to 7b, we saw the contention about constructive consideration being received. Okay. So here also maybe that contention can be made that yes, it is only a constructive consideration that is being received. In effect, I don't receive any monetary consideration, and therefore on conversion, again 56(2) should not apply. Uh, Under which occasions there is an exemption given under 56 to 10. So all these are the occasions. Rule 11 you say okay, this is a transfer. So all these are basically corporate reorganization events. Here when central government suspends the board. Here is for a reconstructed bank. Here is for a disinvestment event, and here is for a uh, uh, fund which is relocating to India. So in all these cases, 56 to 10, there's a presumption that it should not arise, and therefore there has been an exemption that is being given under that. Now for 56 to 10, what are the valuation norms, if at all it applies? That is what I have given here. I don't think I will go through this for quoted shares. Mind you, this is rule 11U1, not 2. 2 is only for 56 to 7B, 1 is for 56 to 10. Here it is NEV method. And apart from NEV method, if it is other than quoted, other than equity shares, unquoted. So here it will be CCDs, okay, CCPS, RPS, okay, OCD. All instruments would cover here. That is any price that would be fetched in the open market valuation from merchant banker or an accountant. The last aspect is just take 2 minutes. Double tax avoidance implication, a very short aspect. If an income is taxed in the hands of 56 to 10 or in the hands of the individual in the hands of 68. So both the sections have covered here. 56 to 7b is in the hands of company. DTA cannot come to the rescue. 56 to 10 is the shareholders. Non-resident under 68, if the person is non-resident and 68, there is an unexplained credit in the non-resident's books of accounts, then in that case, can DTA at all come to the rescue? Okay. So you will find some judgments also here in case of 68 IFOS. Okay. Here is where the person was a non-resident. Because of the search and survey proceedings that were carried out in the case of an Indian builder, they found that certain on account money was paid by the non-resident. So therefore, that examination was done in the hands of 68, in the hands of non-resident under section 68, and it was alleged that yes, this is unexplained source of money. So therefore, we will tax you under section 68. Now, that person was a resident of UAE. UAE, if you see the other income article, only UAE has got the right to tax. 68 goes under IFOS, same as 56 to 10. Okay, this will also go under IFOS. So if you are coming from those set of countries which have favorable DTA with India, where only the resident country can tax the other income, then in that case you will be out of 56 to 10 and 68. This was the short point here. And with this, we come to the end of our presentation. A lot of efforts have gone in preparing the presentation. My colleagues have worked very hard, Naisa, Lakshmi, Ishita. So I'd like to acknowledge them at this moment. If there are any questions, then yes, we can take them up now. Yes, are there any questions? I can't see the chat option here. Yeah, now I can see the chat option. Okay. So there is one question. I have a small question. Please reply post presentation on whether 56 students applicant on rights issue. I think this is something that I have already dealt with in the same proportion, you will find a lot of judgments in your favor. Then there is one more, angel tax being anti-abuse. Can it be set off against current year PGBP or unabsorbed depreciation? So I think the general principles for set off would apply. Unlike Section 68, it is not to be taxed on a gross basis without allowing any expenditure or set off. Therefore, I would tend to believe that yes, IFRS income that can be set off against PGBP, that can be done. Another question, whether 56 to 10 applicable in case of sale of shares by non-resident to a resident. Yes, it is applicable. So there is no exemption for a non-resident from the clutches of 56 to 10. It equally applies to residents as well as non-residents. So, yes. Are there any more questions? There is one more question here. Whether 7 years restriction is from date of receiving share premium by startup or from the date of startup registration. I believe it is from the date of receiving share premium. I will still confirm that. Let me go to the slide. Startup notification. Yep. Should not have invested in shares. Invested in, if the shares issued at a premium, not to invest for 7 years. Just one moment, let me check from the notification directly. But I still believe that it is post the share issuance and not from the date of the notification. Just one moment, yeah. Yeah, so uh, provided that the startup shall not invest in any of the assets specified in subclauses A to H for the period of 7 years from the end of the latest financial year in which the shares are issued at a premium. Yes. So I think you got your answer. Yes. There is one more question. What is considered as FMV for transfer pricing in case of transfer of shares? So there is no specific method that has been prescribed, unlike Rule 11U UA. So therefore, I think it is open to the valuer's judgment, whichever method that they want to apply, and they can adopt that for ascertaining ALP. Yes. Are there any more questions? No, there are no more questions. I'll wait for a minute or two if you want to post in your queries. If not, then I think we will end the session here. Uh, Thanks, Taxman, and thanks to all the participants for being there. This has been a learning experience, joining the dots, comparing the transfer pricing provision, DTA. So those all are new learnings for us also. So